Silver reaches $80. COMEX registered silver plunging. Toward zero? Will it hit empty by Feb 27? This is not a price alert. This is not a prediction. This is a status report on a market that is running out of time. 88 million ounces against 240 million in open contracts. The math doesn't lie, and the calendar is already counting down. February 27th is not far. What happens when the vault hits zero? Stay right here. Because what comes next changes everything. Welcome to Financial Crisis Explained, where the numbers speak louder than the noise. Now, before we go any further, if you're new here, think of this channel like that one wise old friend, the one you call at 2 a.m. when the market doesn't make sense. He never panics, he never guesses, he just sits down, looks you in the eye, and tells you exactly what is happening and why it matters to your money. So if you haven't subscribed yet, do what your grandfather always told you to do. Son, when something is good for you, don't wait. Hit that subscribe button. It costs you nothing. But what you learn here could save you everything. And one more thing before we begin. Drop in the comments right now. Where in the world are you watching from? Are you in the US, UK, Middle East, Asia, or somewhere we haven't heard from yet? Let us know below, because this story we're about to tell you affects every corner of this planet. Now, let's get into it. There are moments in financial history when a single number appears on a screen, and the people who understand what it means go very quiet. This is one of those moments. Silver has reached $80 per ounce. And for the casual observer, the retail investor scrolling through headlines at breakfast, that sounds like good news, a rally, a milestone, something to celebrate. But for the analyst sitting behind 3 monitors at 5 a.m., studying vault reports, tracking open interest, cross-referencing delivery obligations against registered inventory, that $80 number is not a celebration. It is a signal. And the data sitting underneath that signal right now is arguably one of the most consequential setups the silver market has seen in decades. First, understand what COMEX actually is. The COMEX, the commodity exchange, is the world's primary futures market for silver. It is where contracts are written, bought, and sold between institutions, hedge funds, banks, and commercial traders. Billions of dollars in silver exposure trade through this exchange every single day. But here is where most people get confused. When you trade a silver futures contract on COMEX, you are not necessarily buying silver, you are buying a promise, a legal obligation that says, at the end of this contract, physical silver can be delivered if the buyer demands it. The keyword is can. Most traders never demand delivery. They roll their contracts forward, extending the obligation into the next month, and the cycle continues. The system works as long as the silver is actually there. And that is precisely where the story gets uncomfortable. COMEX silver is divided into 2 categories. The first is eligible silver, metal sitting in approved vaults that could become available for delivery, but has not yet been registered for that purpose. The second, and far more important, is registered silver. Registered silver is the metal that is warrant issued, formally committed, actually available for physical delivery against active futures contracts. It is the only number that truly matters when you are assessing whether COMEX can meet its obligations. And as of this report, COMEX registered silver stands at 88 or 19 million ounces. That number has been falling, not slowly, not gradually. It has been declining with a consistency that serious market participants have been tracking with increasing concern. Now place that number next to this one. March open interest on COMEX, the total number of active futures contracts that have not yet been settled, rolled, or closed when converted into ounces, sits at approximately 240 million ounces. Read those 2 numbers again. 88 million ounces registered and available for delivery, 240 million ounces in open obligations. The gap between those 2 figures, roughly 152 million ounces, is what analysts refer to as the implied deficit. It is the distance between what COMEX has promised and what COMEX actually holds in deliverable form. Now, this gap alone does not cause a crisis. Markets have operated with structural imbalances before. The roll process exists precisely to manage this. Traders roll their contracts forward. Delivery demands remain a fraction of total open interest. The system clears, usually. But here's what makes this moment different. When you take that implied deficit and divide it by the current daily rate at which open interest is being reduced through the roll process, you get something very specific. You get a timeline. At Thursday's roll pace, approximately 30 million ounces per day. That timeline points to one date with uncomfortable precision, February 27th. That is the date the math currently projects for COMEX registered silver reaching critical exhaustion levels. If inflows do not materialize and the roll pace does not accelerate significantly, this is not a rumor. This is not a conspiracy theory circulating on financial forums. The vault data is public. The open interest figures are published daily. Anyone with the patience to read primary sources can verify every number referenced here. The question is no longer whether the pressure exists. The pressure is documented. The question, the one that every serious market participant is now asking behind closed doors, is whether the system has enough time to correct itself before February 27th arrives. The timeline, the roll process, and the February 27th deadline. Most people never read the footnotes. They see the headline. They react to the price. They form an opinion based on what someone else already digested for them. And in ordinary markets, during ordinary times, that approach carries a manageable level of risk. But there are specific moments in financial history when the footnotes are the story. When the detail buried on page 7 of a vault report, or the quiet shift in a single line of open interest data, carries more weight than every headline published that week combined. This is one of those moments. And to understand why February 27th has become the most quietly discussed date in commodity markets right now, you need to understand a mechanism that most people have never heard of, the roll process. Here is how the architecture works. When an institution buys a silver futures contract on COMEX, they are entering a legally binding agreement. That contract has an expiration date. When expiration approaches, the buyer faces a choice. They can demand physical delivery of the silver, or they can roll, closing their current contract and opening a new one in the next available month, essentially extending the obligation forward in time without ever touching the metal. For decades, this rolling mechanism has been the silent engine that keeps COMEX functioning. The vast majority of futures participants, hedge funds, trading desks, macro managers, have no interest in receiving physical silver. They are trading paper exposure, so they roll, month after month. The cycle repeats, the vaults are rarely stressed, the system is elegant, in theory. But the theory carries one critical assumption buried deep inside it, that the silver is there if someone actually wants it. Now apply the mathematics to the current situation. COMEX registered silver, the only inventory formally available for physical delivery, sits at 88.19 million ounces and declining. March open interest converted to ounces stands at approximately 240 million. The implied deficit, the gap between obligation and available metal, is roughly 152 million ounces. To close that gap before March contract expiration, open interest must be reduced through rolling at a sufficient daily pace. Contracts must be closed, extended, or settled in cash. The 240 million must come down fast enough that the 88 million never gets genuinely tested. Thursday's data provided one encouraging data point. The roll pace hit approximately 30 million ounces per day, exactly where it needed to be to keep the timeline manageable. One day, one data point. And already certain corners of the financial media began treating it as resolution, as evidence that the concern was overblown, that the market was self-correcting and the alarm could be lowered. That interpretation is premature, and the people making it are not reading the full data set. Because here is what one good day actually tells you. It tells you the mechanism still functions. It tells you that institutional players are rolling at pace when pressure is applied. It tells you the market has not yet seized. What it does not tell you is whether that pace is sustainable. What it does not tell you is whether physical inflows into COMEX vaults are materializing in parallel, which is the other variable the roll process cannot replace on its own. A sustained roll pace reduces open interest, but it does not increase registered silver. And if registered inventory continues declining while open interest rolls forward, you're not solving the structural problem. You are relocating it. You are moving the pressure from March into April, and this is where the February 27th timeline demands precise interpretation. That date does not represent a default. It does not mean COMEX issues a notice of force majeure on the morning of February 28th. Markets do not collapse with that kind of cinematic punctuality. What February 27th represents, based on the current rate of registered inventory decline mapped against delivery obligations, is the point at which the buffer disappears. The margin for error reaches zero. The registered silver that sits between the current system and a genuine delivery stress event runs out. At that point, COMEX is no longer operating with a cushion. It is operating on the assumption that every single contract outstanding will roll, that no major buyer will stand for delivery, and that new silver will enter the vaults in time. That is not a market functioning with confidence. That is a market functioning on faith. And in commodity markets, faith has an expiration date too. The question serious analysts are now asking is not whether February 27th is the end of something, it is whether it is the beginning. When March clears, but the crisis doesn't, there's a particular kind of danger that disguises itself as relief. It arrives quietly, it follows a moment of genuine tension, a close call, a near miss, a data point that briefly suggested the worst was possible. And then something shifts. The immediate pressure eases, the numbers stabilize, the headlines soften, and the collective attention of the market, always hungry for resolution, moves on. History has a name for this pattern. It is called a false clearance. And right now, as March open interest begins rolling at pace, as February 27th approaches with slightly less alarm than it carried 72 hours ago, there's a very real risk that the market interprets a temporary stabilization as a structural solution. It is not. March is not the end of this story. April is where the pressure goes next. Understand the architecture of what just happened. The roll process, as established in Part 2, is a mechanism for moving obligation forward in time. When a March futures contract rolls into April, the delivery demand does not disappear. It relocates. The open interest moves, the clock resets, and the registered silver sitting in COMEX vaults remains exactly where it was, possibly lower. Because here is the variable. Most casual observers are missing entirely. While the roll process manages the paper side of the equation, the physical side operates on completely different mechanics. Registered silver does not increase because contracts rolled successfully. Registered silver increases only when new metal physically enters approved vaults and is formally warranted for delivery. That process is slower. It is logistically complex. It depends on mining output, refinery throughput, transportation, and, critically, on the willingness of silver holders to deposit their metal into the COMEX system rather than holding it elsewhere. And right now, that inflow pipeline is not delivering at the scale this market requires. Consider the structural reality beneath the surface. Global silver mine production has been running below demand for multiple consecutive years. This is not a new development. It is a slow-moving supply constraint that has been documented in industry reports and largely ignored by mainstream financial commentary because its consequences move too gradually to generate consistent headlines. But gradual constraints have a habit of becoming sudden crises. When you layer years of below-demand mine supply on top of declining COMEX registered inventory, on top of accelerating industrial consumption, and then introduce a futures market stress event that forces physical delivery obligations into sharp focus, you're not looking at isolated pressure on a single contract month. You're looking at the first visible fracture. In a much larger structural shortage, April open interest is now the number to watch. As March contracts roll forward, a significant portion of that open interest does not simply vanish into the financial ether. It reestablishes in April. New contracts open, new obligations form, and the registered silver that must stand behind those obligations is the same silver that couldn't comfortably cover March. The buffer has not been rebuilt. The inflows have not materialized at scale. The vault reports, available publicly for anyone disciplined enough to read them daily, show no significant surge of new metal entering the registered category, which means April arrives not as a fresh start, but as March, with less margin. Now consider the industries watching this in real time. Silver is not simply a monetary metal held in vaults and traded on exchanges. It is an industrial input of extraordinary strategic importance. Approximately 50% of annual silver demand comes from industrial applications, solar panel manufacturing, semiconductor production, medical equipment, electric vehicle components, and advanced defense technologies. These are not discretionary purchases. A solar panel manufacturer cannot substitute away from silver. A semiconductor fabricator cannot pause production while waiting for spot market conditions to normalize. These industries operate on supply contracts, procurement schedules, and production timelines that have zero tolerance for spot market disruptions. When COMEX registered inventory declines to stress levels and physical delivery becomes genuinely uncertain, industrial buyers do not wait for resolution. They accelerate their purchasing. They pull forward demand. They compete aggressively for the same shrinking pool of available metal. And in doing so, they apply additional upward pressure on the very price signal that already told us something was wrong. The $80 price is partly the market pricing this risk in real time. And here is what serious market participants already understand. The institutions that manage large physical silver positions, the ones with direct relationships with refineries, with allocated vault accounts outside the COMEX system, with the analytical infrastructure to read primary data daily, they are not waiting for February 27th. They are not waiting for April. They have already repositioned. The investors who will be most affected by what comes next are the ones who saw the March pressure ease slightly, exhaled, and assumed the story was over. The story is not over. March was the warning. April is the examination. And the question this market will answer in the weeks ahead is whether enough silver enters COMEX vaults in time to prevent April from becoming something far more serious than a pressure point. Strategic implications for decision makers. Every crisis has two kinds of witnesses. The first kind watches events unfold in real time, processes each development as it arrives, reacts to headlines, adjusts when the damage is already visible, and spends the aftermath asking why nobody warned them. The The second kind reads the data before the headline exists. They study the vault reports. They track the open interest. They understand the roll mechanics. They see the implied deficit widening weeks before it becomes a news story. And when the pressure finally surfaces into public consciousness, they are not scrambling. They are already positioned. This final part of the analysis is written exclusively for the second kind of person. Because what is happening in COMEX Silver right now is not a story about metal prices. It is not a story about futures contracts or vault reports or roll mechanics. Though all of those elements matter deeply, it is a story about what happens to capital, to supply chains, to business strategy, when a foundational commodity market approaches a stress threshold that the mainstream has not yet priced. Begin with silver's dual identity, because most people only understand half of it. In public conversation, silver is discussed primarily as a monetary metal, a store of value, a hedge against inflation, the smaller, more volatile sibling of gold. And that framing is not wrong. It is simply incomplete, because silver is simultaneously one of the most industrially critical commodities on the planet. No other element conducts electricity as efficiently. No other material matches its thermal properties at scale. No other commodity sits at the intersection of so many defining industries of the next 2 decades simultaneously: solar energy, electric vehicles, semiconductor manufacturing, advanced medical diagnostics, missile guidance systems, satellite components, 5G infrastructure. Every single one of these industries depends on silver as a non-negotiable input. And here's the strategic reality that every business decision maker needs to internalize right now. When a commodity is both a financial instrument and an industrial necessity, a stress event in its futures market does not stay contained to the trading floor. It moves, it travels through supply chains, it appears in procurement costs, it surfaces in manufacturing margins, it forces pricing decisions that ripple downstream to end consumers. And by the time those consequences become visible at the business level, the window for strategic preparation has already closed. Consider what a genuine COMEX delivery stress event looks like from inside an industrial supply chain. A solar panel manufacturer operating on quarterly procurement contracts suddenly finds that spot silver availability has tightened significantly. Their supplier, who sources from COMEX adjacent channels, cannot guarantee the volume originally committed. Lead times extend, spot prices accelerate. The manufacturer faces a choice between accepting margin compression or passing costs forward to their customers. A semiconductor fabricator running lean inventory, as most do in a normalized supply environment, discovers that their 60-day silver buffer is no longer sufficient in a market where physical availability is genuinely uncertain. They enter the spot market aggressively. Their purchasing competes directly with every other industrial buyer facing the same constraint simultaneously. A medical device company with regulatory obligations tied to specific material specifications cannot simply substitute an alternative. Their production timeline is fixed. Their silver requirement is fixed. Their negotiating position in a stressed physical market is not fixed. These are not hypothetical scenarios constructed for dramatic effect. These are the logical consequences, documented by supply chain analysts and commodity economists, of what happens when registered inventory in the world's primary silver futures market approaches exhaustion while industrial demand continues at pace. Now translate this into the language of capital positioning. Institutional players, the funds, family offices, and treasury operations that manage serious capital, do not respond to commodity stress events reactively. They have frameworks, they have trigger points, they have pre-established responses that activate when specific data thresholds are crossed. Several of those thresholds are being crossed right now. When registered silver inventory declines toward levels that make physical delivery genuinely uncertain, institutional capital does 3 things with remarkable consistency across historical precedent. First, it moves toward allocated physical positions, not paper exposure, not ETF shares, not futures contracts, actual metal held in segregated non-COMEX vault accounts where delivery risk is eliminated entirely. Second, it reduces exposure to industries with unhedged silver input costs. Manufacturing companies, technology hardware producers, and renewable energy developers with no commodity hedging program become vulnerable positions in a stressed silver environment. Third, and this is the move most relevant to entrepreneurs and emerging business leaders, it begins pricing the scarcity before the scarcity becomes official. Silver at $80 is not the ceiling being discussed in serious analytical circles right now. The price trajectory implied by the structural data, declining mine supply, rising industrial demand, stressed futures inventory, and accelerating institutional repositioning points toward levels that would have seemed implausible 18 months ago. For the entrepreneur and the aspiring business leader watching this analysis, the strategic lesson here is not simply about silver, it is about the discipline of reading primary data before the crowd arrives at the same conclusion. The COMEX vault reports are public. The open interest figures are published daily. The industrial demand projections from the Silver Institute are freely available. Every data point referenced in this four-part analysis can be verified independently by anyone willing to invest the time. The market inefficiency being exposed right now is not informational. The data exists, it is accessible, the inefficiency is attentional. Most market participants, most business leaders, most investors, most entrepreneurs are not reading vault reports. They are not tracking registered inventory against open interest on a daily basis. They are not mapping the roll pace against the implied deficit and calculating a timeline. They are waiting for a headline. And the headline, when it finally arrives, will not come with a warning. It will arrive the morning after the window closed. So here is the strategic brief, stated plainly. For every serious decision maker watching this, if your business touches silver in any form, as an input, as a component, as a material in your supply chain, the time to review your procurement strategy and inventory buffer is now. Not when spot prices have moved another $20, not when your supplier calls to renegotiate terms. Now, if your capital is exposed to industries with unhedged silver input costs, understand what a sustained move in physical silver availability means for their margins before that pressure appears in their earnings reports. And if you are an investor, an entrepreneur, or a capital allocator trying to understand where asymmetric opportunity exists in this environment, study the footnotes, read the vault reports, track the open interest, follow the data to where the crowd has not yet arrived. Because the most important financial developments in history were never announced in advance. They were visible in advance to the people disciplined enough to look. This has been Financial Crisis Explained. The data is public. The timeline is documented. The decision is yours.